You're literally throwing a fortune down the drain right now. And the worst part is, you don't even realize it's happening. If you're over age 45 with more than $300,000 in your account, you're a prime target for institutional wealth destruction this end of financial year. We're talking about an estimated $30,000 in hidden fees and unnecessary taxes that should be sitting securely inside your own retirement nest egg, rather than funding corporate profits or feeding the ATO. Today, you'll discover the exact playbook to claw back that capital before the upcoming 30th of June deadline permanently slams the door shut on your options. It's an urgent situation, because the clock is ticking rapidly and the rules aren't designed to favor the uninitiated investor. But before we dive into the raw data and tactical math, here is a critical warning for compliance. General information only does not constitute personal financial, taxation, or legal advice. Always remember to consult a professional who understands your specific situation before moving large tranches of cash, because once the financial year finishes, these strategic opportunities disappear forever. Let's dissect the core architecture of your retirement account, because most executives are completely blind to how pre-tax money accumulates efficiency. The ATO has recently modified the landscape, meaning your annual limit for concessional contributions has officially increased to $30,000 for this current financial year. That's a massive window of opportunity for anyone sitting in the top marginal tax brackets who wants to legally lower their taxable income while simultaneously boosting their retirement base. If your salary exceeds $135,000 or pushes past the $190,000 mark, you're paying up to 45 cents in tax for every single dollar earned at the margin. That's an absolute slaughterhouse for wealth creation. The solution is an immediate, aggressive implementation of a salary sacrifice arrangement with your employer's payroll division. By redirecting a significant portion of your gross corporate salary straight into your super fund, that capital is taxed at a flat rate of just 15% inside the fund structure rather than your high personal marginal tax rate. That's an instant, guaranteed tax saving of up to 30% on every dollar sacrificed. Why would anyone willingly leave that money on the table for the government to spend? Imagine an executive named David who earns $220,000 a year and has a standard balanced fund account balance of $450,000. By setting up a structured salary sacrifice arrangement before the end of financial year, David can inject thousands of dollars extra into his fund up to that $30,000 limit. This simple, elegant administrative adjustment immediately reduces his personal taxable income, resulting in thousands of dollars saved on his upcoming tax return. It's not magic, it's just pure institutional financial engineering that the wealthy use every single day to stay ahead of the game. However, you must execute this flawlessly because the ATO doesn't accept excuses if you accidentally breach your statutory thresholds. If you overshoot the mark, the tax penalties can become quite severe and wipe out the initial benefits entirely. So you've got to review your year-to-date pay slips immediately to calculate your remaining headroom down to the exact dollar before making your next move. Stop right there. We need to have a serious, completely unfiltered conversation about your money right now. Are you genuinely confident that your current fund isn't quietly bleeding your wealth dry through hidden management expenses? Pause this video immediately and leave a comment below stating your exact financial pain point or fund name, because I respond to every high net worth viewer personally. Now let's expose the deep systemic rot inside the financial sector where your retirement capital is currently being stored. Many Australians are blindly trapped inside expensive retail funds that are heavily burdened with layers of trailing commissions, platform fees, and unnecessary insurance premiums that quietly erode their compounding growth over decades. On the other hand, while industry funds generally offer lower cost structures, they aren't immune to default, underperformance, or hidden investment costs that fail to show up on your standard annual statement. If you have over $300,000 accumulated, a mere 0.5% difference in annual management fees represents an estimated $30,000 or more lost over your remaining working life due to the devastating compounding effect of those charges. It's an absolute tragedy that most people only discover when it's far too late to fix. But the wealth destruction doesn't stop at basic administration fees. High earners must also contend with the brutal reality of the Division 293 tax threshold. If your combined adjusted taxable income plus your concessional super contributions exceeds the $250,000 statutory threshold, the ATO will hit you with an additional 15% tax on your super contributions. That effectively doubles your super tax rate from 15% to 30% on those amounts. It's a highly punitive mechanism designed to penalize high-performing corporate executives across Australia. Now, let's discuss the absolute worst operational danger facing every single individual watching this video as June approaches. It's a systemic failure mechanism I call the BPI death trap. Most high-net-worth investors believe they can simply log into their online banking portal. On the evening of 29th June, process a quick transaction using a BPAY code and successfully claim a tax deduction for that financial year. That's a catastrophic misconception that ruins thousands of tax strategies every single year. The strict law states that contributions are only counted when they are actually received and cleared by your superfund's bank account, not when you initiate the electronic transfer from your bank. Processing delays between major banking institutions and fund clearing houses can take anywhere from 2 to 5 business days to clear completely. If your voluntary contribution lands in the fund's account on 1st July rather than 30th June, it's completely disqualified for that financial year. Your expected tax deduction is instantly vaporized, and the contribution accidentally consumes your cap for the following financial year instead. It's an operational nightmare that leaves executives completely stranded with massive, unexpected tax bills when they eventually lodge their next tax return. To bypass the BPA death trap, you must transfer all voluntary capital into your chosen fund no later than mid-June to guarantee it clears the institutional pipelines in time. But here is the ultimate, highest value economic secret that your fund will never volunteer to tell you. It's the powerful carry-forward rule for concessional contributions. If your total superannuation balance was below $500,000 on 30th June of the previous financial year, the law allows you to claw back and utilize any unused portions of your annual concessional caps from the past 5 consecutive years. This means instead of being limited to just $30,000 this year, you could potentially inject $50,000, $100,000, or even more in a single highly strategic tax-deductible block if you have accumulated unused capacity. This is the ultimate wealth acceleration tool for high-income earners over age 45 who need to rapidly make up for lost time and legally erase a massive chunk of their personal tax liability in one clean move. Before taking action, remember, general information only does not constitute personal financial, taxation, or legal advice. Don't allow the system to bleed your hard-earned wealth for another single day. If you're ready to secure your financial future and stop giving the tax office an unearned tip, make sure you hit that subscribe button to Aussie Super Secrets right now for high-conviction financial clarity. In our very next episode, we'll break down a secret 2026 tax loophole closing on 30th June that lets you legally shelter an extra $120,000. Using smart salary sacrifice setups, you can't afford to miss it. Click the link below to watch it immediately. Stay disciplined, and we'll see you in the next briefing. Disclaimer: The information provided in this video is for general educational purposes only and does not constitute financial, taxation, legal, or home loan advice. It has been prepared without taking into account personal objectives, financial situation, or needs. Before acting on any information, it is recommended to consider its appropriateness and consult with a licensed professional, such as a financial planner or tax agent. Specific results or future performance are not guaranteed. 2026 Aussie Super Secrets. All rights reserved.